Greetings. I'm Nik Schuurmans, President and Chief Investment Officer of Pure Portfolios. We are back recapping the month of July. Many investors are asking, have we come too far, too fast? So we're going to look at previous bear and bull cycles, how far we've come, how that relates to history. We're going to look at the U.S. housing market, what happens with interest rates. We have a lot of good graphs. So let's get into it. Today is Tuesday, July 29th. So starting at the bottom, the green SGOL, that's gold. Gold's been a juggernaut this year. Great store of value, great hedge against inflation. As the U.S. continues to debase the dollar, I think gold and Bitcoin check a lot of boxes. We'll get to Bitcoin in a minute. Blue is a snapshot of the U.S. bond market, AGG. Bond returns are heavily influenced by starting yields. Most bonds are positive on the year. Most bond returns are a function of investment income, which take the entire 12 months of the year to pay out. But bonds have resumed their role as a hedge against most folks' riskiest asset class, which are equities. Purple SCHF, that's international developed. Solid year, pretty solid month. Think Greater Europe, Australia, Canada, which were deeply out of favor the last decade. Vastly outperforming U.S. equities this year. It's nice to see that. REITs, I always say this is not your grandfather's REITs. These are data centers. Think AI, think storage units, cell phone towers. More of a modern REIT, which have been out of favor. REITs historically are a really good inflation hedge. They're a tangible asset that you can touch. One thing that has been a headwind to REITs has been higher cost of capital, higher rates. So certainly every real estate person on earth is rooting for the Fed to cut rates. SLYV, that's small cap and value, two factors that have been deeply out of favor. However, this asset class, this ETF has a pretty good run over the past few months. And if you're looking for value and two factors that have worked over the past 80 years in history, this is a pretty good place to look. SCHE, that's emerging markets. Heavily influenced by China. China equity markets have had a really good year despite all the trade narrative. They continue to act better given the progress for U.S. and Chinese trade. The blue is the S&P 500, up over 3% the month of July, fueled by big tech, fueled by AI. A lot of those themes are starting to be in vogue again after being deeply out of favor for most of this year. And lastly, Bitcoin, which has been a juggernaut. You know, I always say this, but Bitcoin has really even surprised me. And I've been a longtime Bitcoin believer, but it's just on a fast track. It has supreme momentum to becoming a accepted asset class in government, for corporations, for institutional investors, for retail investors. And it's been pretty cool to see the journey, which again has far exceeded even long-time Bitcoin bulls. Let's look at the U.S. consumer. So goes the consumer, so goes the U.S. economy. There's been a lot of coverage about how the U.S. consumer is stretched. Credit card debt at all-time highs, revolving debt at all-time highs, auto loan defaults, all of these things, student loans. But you can't look at the liability side of the balance sheet without looking at the asset side of the balance sheet. So what this is, it's a ratio of U.S. household leverage. What we owe divided by what we own. And when this ratio is going up, when it peaks out like it did in 2015, let's call it, that means the U.S. consumer is highly indebted. This is where we're currently at now. And when you factor in, most asset prices are at all-time highs. Think Bitcoin, think stocks, think real estate. Looking at debt through that lens, when you factor in the asset side of the balance sheet, consumers really aren't so stretched. This is a compelling story where it really flies in the face of the narrative that consumers are tapped out, they're borrowed out, they don't have any credit available to them. You have to also look at the asset side, which paints a much better history, especially when you look at recent history. Have we come too far, too fast? This is the Goldman Sachs Nonprofitable Tech Index from 2014 to 2025. And basically what we're looking at is the performance of tech companies that are not profitable. Many use this as a gauge to see how frothy or not frothy we're currently trading at. So let's go back post-pandemic, where this index of non-profitable tech companies was really going crazy. And post-pandemic, many people thought that our way of life would change forever. A lot of really junky type of names that weren't making money ascended higher with no end in sight. And often as it did back in 2021, it marked a top for markets. And a lot of these junky tech names were up fourfold post-pandemic. And we all know what happened in 2022. That was a sign of a top. We sold off aggressively, higher rates, higher inflation. Many of these not profitable, frothy tech names really got crushed. So where are we today? What is the frothiest corners of the market telling us? Well, they've certainly gone up, but nowhere near the euphoria and excess that happened in 2020 to 2021. So have we come far? Has it been a short period of time? Yes. Are we trading at the frothiest levels with the meme stocks, the junk names ascending higher? Not quite at the levels of 2021. So that bodes well. Let's look at inflation. A lot of talk about rates. The president wants rates much lower. Rates are really a function of inflation and growth. And you can even throw in asset prices too. The Fed doesn't admit that, but they do look at how assets are trading as they make decisions. So what this is essentially a measure of cumulative inflation over the past 10 years or so. So the light blue line is the trend line if inflation was 2% over the past 10 years. Of course, we know inflation was not 2% over the past 10 years. It's actually been 4% post 2020. That's the red line. So the blue line is the 2% trend inflation, where it should be based on the Fed's preferred metric. The red line is what it's actually been. And it's running about 2% or double the trend line, or 11.4% above trend line since 2020. Long story short, inflation's been too high over the past 5 years. Inflation is still above the Fed's preferred 2% target, which is why the Fed has been slow to cut rates. However, we have made progress. So moving to the next slide, we've been told that tariffs are going to cause inflation. Pretty much every media outlet, investor, economist has said tariffs are inflationary. Just because people are saying tariffs are inflationary doesn't mean you actually get inflation. What's actually happened is inflation has surprised to the downside. So every inflation report, economists project what the number is going to come in at, and then we track what actually happens. Economists have overestimated inflation over the past 3 months, and you see that with this downward blue bar. This is inflation readings versus expectation. When this blue chart is lower than the zero bound, that means we got an inflation surprise to the downside. When this blue line is above the zero bound, that means inflation has surprised to the upside. That's really bad. Markets hate inflation. They really hate unexpected inflation. And this is good news for U.S. consumers, U.S. investors. Inflation is surprising to the downside. It's been a while since we talked about the housing market. This is the most unaffordable housing market in recent history. And this is a very powerful chart. What it shows is this blue line is the median U.S. household income, roughly $80,000. Based on current home prices, the median income needed for a U.S. household to purchase a new house is $120,000. That's a 56% affordability gap versus the income needed to buy versus actual income. I feel like sellers are still anchoring to 2020, 2021 pricing. They've been very slow to cut prices. There is a lack of buyers out there, and more supply is coming on the market. There's many, many more sellers than buyers right now, which means it's only a matter of time before prices have to come down. They've already started to come down in some of the softer markets. However, in order to close this gap, either income needs to go up, which this gap is much too big for that to close quickly, or more likely, prices need to come down. Going back to the theme of have we come too far too fast? I think history is a really good lens to look through. There's a lot going on here. In the left column, S&P bear markets, we're tracking every negative 20% market since the 1920s. Okay, so we're not going to get into every instance. What I wanted to show you is the average downside for a bear market is about 35% down. Okay, the length of the average bear market is 286 days. So roughly 30% down. Most bear markets last for the better part of a year. On the bull side, this helps put things into context where we're currently at. The average gain for a bull market is about 115%. The average length in days is over 1,000. Okay, so in general, bull markets last a lot longer and they move much more aggressively than bear markets. So I often say it's okay to be bearish, not okay to stay bearish. Markets have a positive skew, a bias to the upside in the US, which is a blessing. That's not the case for every country. Where are we in the current cycle? So despite the sell-off in 2025, this is still very much a bull market. So from October 22 to July 25, we've gone up 78% for the S&P with a length of about 1,000 days. So when we look at this, we're below the average bull market return, but in days, we're pretty much spot on. But when you look at median, we're pretty much in line with the median return, about half of the median days for a bull market. So you can spin this any way that you want. The takeaway is bear markets are down markets, but they're much more shallow than bull markets. They're shorter than bull markets. Bull markets can go on longer than most people expect, and they're often longer than bear markets. As of this recording, the S&P 500 is up about 8%. What I want to show here is how often we achieve an average return of 8% for the S&P 500, which is essentially the long-term average. And the answer is it's very rare for the S&P to finish the year at 8 or 9%. And we've highlighted those instances going back to 1950. It's only happened 4 times since 1950. So 4 times out of 75 years has the S&P realized a calendar year return that's consistent with the long-term average of 8 or 9%. Usually markets are up much more than the long-term average, or we get these ugly, crooked down years. So very rarely do we achieve these 8 to 9% long-term average years, which means for the rest of this year, there's probably a case to be made that we run higher, a case to be made that we stay where we're at, or a case to be made that we sell off and achieve a much more muted return. You see, there's many instances of a sub 5% return, a 5% return for the S&P. So the takeaway is an average year is not so average. It's rare to achieve the long-term average return of 8 or 9% for the S&P. I've heard some investors say, I'm going to hold off on investing because we're at all-time highs. Failing to invest because we're at all-time highs usually doesn't end well. All-time highs tend to lead to more all-time highs. Now, I'm not predicting what happens next, but what you can see here is we've tracked all-time highs by year, every year since 1929. And what you'll notice, these blue highlighted areas that you see cluster, all-time highs cluster, which is why I say all-time highs tend to lead to more all-time highs. And so far in 2025, if I told the average person on the street to guess how many all-time highs we've hit this year, I would bet most would not say 14. That would probably be a shock to many folks. I know last year hitting 57 all-time highs would be a shock to many folks. So all-time highs tend to cluster. All-time highs are not a reason to be bearish. They're quite normal in an upward ascending market. So there you have it, short and sweet this month. Based on history, based on our froth index, the non-profitable tech index, we are not at euphoric levels quite yet. However, we do lead with risk management at Pure Portfolios. You want to understand what the pain points in your portfolio are, how much risk you're taking before something happens. Investing is not taking a bunch of risk, seeing your portfolio crater by 30%, and then making a bunch of emotional changes. That's a recipe for disaster. So feel free to shoot us a note at insight@pureportfolios.com. You should know exactly what you're paying for advice, how much risk that you're taking, your range of portfolio outcomes. If you're working with an advisor that only talks about investing, know that we talk about estate planning, tax planning. We use AI tools to help model all of that for you. We use cutting-edge financial planning software. Good advice extends beyond wealth management. So feel free to shoot us a note at insight@pureportfolios.com. Thanks for watching. We'll see you next month.